If you turn 50 this year and you're planning to drop an extra 8 grand into your solo 401k, stop for a second, because there's a real chance your plan document won't let you do it at all in 2026. Not won't let you do it pre-tax. Won't let you do it, period. Here's the mechanic. Secure 2.0. Section 603 says that if your prior year wages from the employer sponsoring your plan topped $145,000, every catch-up dollar you make has to be Roth, after tax. The IRS wrote that threshold into proposed regulations published January 13, 2025. And buried in those same regs is the part nobody's talking about. If your plan doesn't have a written designated Roth feature, the plan can't permit catch-up contributions for affected people at all. Amend it, or those catch-ups are off the table. So the question that actually matters isn't whether you like Roth. It's whether the custodian holding your solo 401k has bothered to update the paperwork. Let's back up, because there's a timeline here that confused a lot of people, including me for a while. Secure 2.0 became law in December 2022, and Section 603 was originally written to bite in the 2024 tax year. Then the IRS blinked. Notice 2023-62 handed out what the agency politely called an administrative transition period. Record keepers were nowhere near ready, and in some cases the plan documents literally didn't exist in a compliant form. That notice said catch-up contributions made in 2024 and 2025 would be treated as satisfying Section 603, even if they weren't designated Roth, which is a very lawyerly way of saying, we're not enforcing this yet. That grace period expired at the end of 2025. For taxable years beginning after December 31st, 2025, the mandate is live. So 2026 is the first year this is real. And the amounts are not small. Per IRS Notice 2025-67, the employee deferral limit for 2026 is $24,500. The age 50 catch-up is $8,000. And if you happen to be somewhere in the 60 to 63 window, the super catch-up is $11,250. That $8,000 figure is up from the $7,500 catch-up that applied in 2025, so the dollars at stake keep climbing. Total defined contribution limit across employee and employer money is $72,000. For a freelancer in a decent year, catch-up money is a meaningful slice of the retirement plan, and losing access to it because your custodian's plan document is stale is a genuinely dumb way to lose ground. Now, before you go into a panic, the threshold is defined in a way that a lot of freelance media has flat out gotten wrong, and this is where I want you to slow down. The proposed regs don't say income over $145,000. They don't say adjusted gross income. They don't say net profit. They don't say Schedule C, line 31. They reference Social Security wages under IRC Section 3121A, paid by the employer that sponsors the plan in the preceding calendar year. FICA wages, the number in box 3 of a W-2. Sit with that for a second, because for a huge chunk of this audience, it changes everything. If you're a sole proprietor or a single-member LLC that has an elected S-corp treatment, you don't pay yourself W-2 wages. You take draws. Your earnings show up as self-employment income on Schedule SE, and you pay self-employment tax, but that isn't Section 3121A FICA wages from an employer. Which means, for the plan your sole proprietorship sponsors, your relevant prior year wage figure is zero. Not low. Zero. The IRS acknowledged this structure in the January 2025 proposed regs. The wage test is applied, employer by employer, plan by plan. My read, and I'll be straight that this is my read, and not settled law. A pure sole proprietor with no payroll has no way to trip the $145,000 trigger for their own solo 401k. The rule aims at W-2 employees. Owner-only compensation just doesn't fit the definition. Contrast that with the S-corp freelancer. If you elected S-corp status and you ran, say, $160,000 through your own payroll last year as W-2 wages, you're plainly inside the rule. You paid yourself as an employee. Your business is the plan sponsor. Box 3 wages over the threshold, prior year, same employer. Done. Your 2026 catch-up has to be Roth. That's the split. Same freelancer, same income, two entity structures, completely different answer. And honestly, I think this is the single most undercovered wrinkle in the entire Secure 2.0 rollout, because the S-corp election is exactly the move high-earning freelancers make around the income level where this rule starts to matter. One caveat before we move on, and it's a real one. If you also have a W-2 job on the side, or you're a partner in an entity that pays you wages, the analysis runs separately for each employer and each plan. So your day job 401k could be caught while your solo 401k isn't. Your specific setup, entity type, whether you run payroll, how many plans you're in, determines the answer, and it's worth 20 minutes with whoever files your return rather than assuming. Also worth flagging, the $145,000 threshold isn't frozen forever. It's indexed for inflation, but only in $5,000 increments, meaning it doesn't nudge up a few $100s a year the way the deferral limits do. It sits still until the cumulative adjustment clears a full $5,000, then jumps. As of the proposed regulations published in January 2025, inflation adjustments hadn't been enough to move it off $145,000. So if you're an S-corp owner, paying yourself somewhere in the $140,000 to $150,000 range, you're going to have to check this number every single year, because your side of the line can change without you doing anything differently. Here's where I'd normally tell you to just go log in and flip a setting. Except you can't, and that's the actual story. A solo 401k isn't really a product. It's a written plan document, a legal agreement between you as the employer and you as the participant, and the custodian supplies the template. Whatever's in that template is what your plan permits. If the document has no designated Roth deferral language, your plan cannot accept Roth deferrals, no matter how much the IRS mandates them and no matter what buttons appear in the app. And the proposed regs are explicit that a plan without a Roth feature must either be amended to add one or stop allowing catch-up contributions for participants over the wage threshold. So the landscape as of the 2026 plan year splits into three camps, and I want you to figure out which one you're in. The first camp is the mainstream discount brokerages that historically shipped prototype solo 401k documents with no Roth deferral feature at all. For years, the standard Vanguard, Fidelity, and Schwab individual 401k documents varied on this. Some added designated Roth deferrals, some did not, and some added Roth deferrals but never Roth catch-up specifically. Those are three different things. Do not assume that we offer a Roth 401k means our document supports Roth catch-up designation and separate accounting for it. The second camp is the third-party administrators and document providers, the outfits whose whole business is the plan document rather than the brokerage account. My experience is that these shops move fastest on amendments, because compliance is literally the product they sell. If your plan is with a TPA, you'll usually get an amendment notice rather than silence. Third camp, the do-it-yourself and checkbook control crowd, where you bought a document years ago and nobody's touched it since. If nobody has sent you an amendment, nobody has amended anything. Documents don't update themselves. Now, I'm not going to read you a chart of who supports what, and here's why. Plan documents get restated and amended on rolling cycles, custodians add features quietly, and a list I recite today could be wrong by the time you watch this. What doesn't go stale is knowing exactly what to ask. Call the custodian or email them and ask 4 things in writing. Does my plan document currently permit designated Roth employee deferrals? Yes or no? Does it specifically permit catch-up contributions to be designated as Roth? Has the plan been amended for Secure 2.0 Section 603? And can you send me the amendment or restatement? And if the answer to any of that is no, what's your timeline and what happens to my catch-up contributions in the meantime? Get it in writing, not a chat transcript with a rep who's guessing. 2 more things people get wrong that I want to close on because they cost real money. First, forced Roth treatment on a catch-up is not a penalty. I help solo workers stop overpaying the IRS, and I'll tell you plainly, I don't think losing the deduction on an $8,000 catch-up is the tragedy people treat it as. You're giving up a deduction worth maybe $2,400 at a 30% marginal rate this year, in exchange for a bucket that grows and comes out untaxed forever. Whether that's a win genuinely turns on whether your bracket in retirement will be higher or lower than it is now, and for a freelancer with volatile income, that's harder to forecast than it is for a salaried person. But my default recommendation stands. If you're forced into Roth, take the Roth and move on. Don't skip the contribution out of spite. Second, and this is the expensive one, if you're an S-corp owner over the wage threshold and your custodian can't accept Roth catch-up, don't just make the contribution anyway and hope. A pre-tax catch-up that was required to be Roth is a plan operational failure, and unwinding that means corrections and possibly filings, a mess that costs more in professional fees than the deduction was ever worth. Fix the document or move the plan. Moving a solo 401k to a provider with a compliant document is paperwork and a transfer, not a taxable event. And if you're a sole proprietor with no payroll who concluded this rule doesn't touch you, good, probably right. But I'd still push you to open the Roth side of your plan if the document allows it. This is my hill. Most freelancers set up the Roth piece of their solo 401k years too late, then spend their 50s wishing they had a tax-free bucket to draw from alongside the pre-tax one. Give yourself the option before Congress decides to make it mandatory for you too. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this saved you a phone call with a very confused customer service rep, subscribe. I put out one of these a week for people running their own books. And if there's a specific 1099 Roth or solo 401k question you want me to take apart, leave it in the comments and I'll pull it into an upcoming video. Next week, I'm covering something that catches a lot of people off guard. No 1099 in your inbox doesn't mean no tax owed, and there's a $2,000 reporting threshold almost nobody has explained properly on video. See you then.